Good afternoon. Welcome to Daily Currency Update from the Currency Desk. Yesterday we saw a sharp fall in the value of Indian rupee. This was mainly being rumored to strong demand from dollars from the importers. Two types of importer demand arose yesterday. First was from those type of importers which had huge FCCV payments. Now it is predicted that around $1.3 billion worth of FCCV payment has to be made till March. So since importers are expecting a rise in the value of dollars in the near term, everyone is trying to make their dollar payments as soon as possible so as to be in favor of the exchange rate. Another type of buying we had from the gold importers. Now gold importers are majorly expecting an import duty hike in the near future. So because of this, they are trying to increase their gold imports before the import duty hike. Along with that, another bullish factor for the US dollar was the Fed FOMC minutes yesterday. Fed has clearly suggested that it may discontinue the quantitative easing 3 program which it has recently launched in the year 2013. Now we have seen the dollar depreciating mainly because of the high-end unlimited borrowing being offered by the Fed. If this is discontinued, we could well see the dollar appreciate in the near term. A lot of commodities also reacted in a very volatile manner, depreciating. We had all the risk assets falling yesterday. We had the global equities down. In the morning session today, the Asian equities were also down because of the Fed FOMC minutes and such indications. The US dollar index has quietly risen up above 80 levels and is currently trading at 80.73. This is also expected to support the US dollar against the Indian rupee. We currently see the US dollar trading higher against the Indian rupee, and this would continue. Technically, we recommend a buy only above 55.17 levels in the spot with a stop loss of 55, that is. In terms of euro, like all the risk assets, the euro also fell yesterday. Though earlier in the day we had some rally in the euro, majorly against the USD. Against Indian rupee as well, it was trying to test the near lifetime highs. Yesterday, the crucial German unemployment data came in much better than expected. The unemployment claims were much lower than what was expected. This unemployment data is crucial because we had a lower PMI and a higher inflation data, which is continuously putting pressure on the European GDP and the European growth. So if we would have a deteriorating unemployment data, the US economic health or the financial health would continue to deteriorate. But since the German jobless claims data was much better than expected, we can expect the Eurozone unemployment data also to be a bit stable and not increase to a great extent. But again, after the FOMC meet, we saw a sharp fall in the euro. It came in much near, it broke the 1.31 level and is now trading near the 1.30 level. Against the Indian rupee, we expect it to remain weak. At current levels, we recommend a sell only below 71.55 in the spot levels. And in the near term, we can target levels of around 71.25. The pound, again, like euro, fell yesterday. But another factor that was putting more pressure on the pound against the Indian rupee and all the global peers was the fact that we had the UK construction PMI, which was lower than expected. Now, what this adds up to is a continuous string of weak data from the UK economy. The UK economic health was predicted to be lower than expected. The UK economy would not show that much growth as in the previous quarters. That was predicted. But what we are seeing is it is being much worse than what is predicted. Due to such weak performance in the jobs and the housing markets, we are seeing that the pound will remain weak against the Indian rupee in the near terms as well. Though this is subject to the fact that we have the INR not depreciating much against the US dollar. But we recommend a hold short in the pound against the Indian rupee with a stop loss of 88.67 in the spot. The Japanese yen also has fallen in value a lot in the recent weeks. This is mainly being related to the fact that there is a revision in the inflation target from the Japanese government from 1% to 2%. What this implies is that we could see much higher levels of quantitative easing or easing done by the Bank of Japan. So if this easing comes in, we could see the value of Japanese yen go down, and this will indirectly support their exporters. Again, in the near term, after the resolution of the fiscal cliff issue, we had the Japanese yen going down as all the investors across the world sold off safe haven assets and bought more risky assets or the risk on assets. Again, due to the current issues or the risk off sentiments being developed in the markets, we could see the Japanese yen rally slightly, and we suggest that based on this rally we sell Japanese yen against the Indian rupee. So currently the trend is sell on rise for the Japanese yen. We can expect the Japanese yen to fall as the quantitative easing is announced in the Bank of Japan's policy meeting on the 23rd of January. All eyes would be on that. Currently we recommend a sell on rise with a target of 62.20 against the Indian rupee. Thank you.